I'm very pleased to welcome back to the show Tim Cestnick. Tim is author. He's founder of the Water Street family offices, but he's got so many letters after his name. It's unbelievable. Tim, I can't even keep up with you, and of course you write in the Globe and Mail and many other places. Tim, thanks for taking time joining us again.
You know, Michael, it's always great to join you this time of year.
Should I just start listing off those letters? So FCPA, FCA, CPA, CEP. My goodness, did you ever leave school?
No, I was a permanent student until my parents forced me to leave the house, and then I had to get a real job.
Well, I know this is such a busy time of year for you, and I do appreciate you finding time, but I just thought, just even in quick snippets, we just start giving people lists of things to keep them, just sort of a mental checklist. And of course, as you're always telling us, tax planning should take place starting probably Tuesday, if you know what I mean. Monday is our deadline. Start it for the next year. But still, even going over some of the things we should recall for this year will get us set up for the next year. So let's start. I want to start with employees for a second. I'll get to investors in a minute, but let's start with employees. And one of the things that I find people are always a little bit confusion surrounding is, when and who can deduct their vehicle expenses.
Yeah, that's a good question. If you are an employee and you're using your car for work purposes and it's your own car, you can claim some deductions potentially. So here's the way it works. If your employer gives you an allowance to cover your costs of your operating your car, and if that allowance is based on kilometers driven, then the CRA, the tax man, looks at that and says, okay, that's probably a reasonable allowance, and if that's the case, we're going to call that allowance tax-free. And then you won't be able to claim a deduction for anything. But if you can argue that your allowance you received or the payments you got from your employer were not sufficient to cover all your expenses, then you can actually add that allowance to your income and claim actual deductions for your car. That's usually the most common way to claim that's the best approach in most cases. So you're going to be adding your allowance from your employer to your income, and then deducting costs of your car, and that's a portion of everything, Michael. That's a portion of gas, repairs and maintenance, your car washes, your insurance, even interest on your car loan.
Okay, I'm just going to keep firing them at you here, Tim.
Sure.
What about the eligible educator school supply tax credit? You got to tell me a little bit more about that.
Yeah, this is news. Relatively new. So teachers who are paying for some of their own supplies for the classroom, and if they're not getting reimbursed for those supplies, those become eligible for a tax credit now called the teachers supplies, educator supplies tax credit, and you can claim up to $1,000 of those costs. So, but it's only if you were not reimbursed. And by the way, here's a little trick that teachers might want to play. If you are working for a private school, and if that private school is a registered charity, you actually might be better off making a donation to the school and then having the school buy the supplies, because there's no $1,000 limit. Then you can increase the limit beyond $1,000. But again, if your school's not of that nature and you can't donate to your school, then you can at least claim a deduction for some of those costs you're incurring. That's
a great idea. Hey, let me just ask about this: employees can deduct expenses, right? And what about, though, if you pay GST? And this is something that I think people would forget. They sort of claim those expenses, like, I don't know, I bought a desk, I bought a computer, whatever it is, stuff that you need to do your employment. But they forget to do anything that you pay GST on that stuff, and PST if you're living out in British Columbia, for example.
Yeah, that's right. So if you're claiming employment expenses, and to do that, you got to file Form T777. So if you're filing that form and you're claiming some expenses related to your employment, which can include the vehicle expenses we just talked about, it might include some other costs you're paying for as well. And if you're paying those costs, then you can claim an HST or a GST, in the case of BC, rebate. You file GST. It's a form called GST 370. File it with your tax return, and you'll get back all the GST you paid on those employment expenses we're talking about.
I will bet you, Tim, big time people forget that one.
Yeah, they do.
There's a lot of, it might be real estate commission salesmen anywhere, by the way, but, and a lot of those, I would bet you they forget that, and it can add up.
And sort of related to that, if once somebody is 19 years old, so you've got a young person in your home, and they're now 19, they're eligible to claim a GST or HST tax credit which gives them back probably up to $300 annually, just in cash back, even if they didn't earn any income. So make sure those kids file tax returns, because not only will it create RSP contribution room if they did earn some income, but it'll also get back this GST credit I'm talking about.
You just mentioned credit, which reminds me, I wanted to ask you about, do you have the option, because I know you do with charitable, don't you? Charitable donations, my spouse and I can pool them and put them on one return, even though she did some and I did some.
That's right. That's good, and that's just good. Very simple and effective strategy. It's not going to make you really rich, but it's going to give you an extra $50 probably in your pocket or more. So the way that works is that you only get a certain amount of tax relief on your donations, and once the donations are over $200 in total in aggregate, then you get more tax relief. So by pooling them all on one spouse's tax return, you get to that $200 threshold faster. And you get more tax relief for doing that. So that makes good sense. And similarly, when it comes to medical expenses, what you want to do is you want to claim them all on the tax return of the lower income spouse, because medical expenses are income tested, so that the higher your income, the less able you are to claim medical expenses. So by claiming it on the lower income return, you'll get more tax relief, and you can just pool your medical expenses like that as well.
You're getting everybody. I hope you're getting the idea why I adore having Tim on here, and there's nobody who I've benefited more from reading their books, and there's so many, like 101 Tax Secrets for Canadians, and I love the Winning the Tax Game. Really got me started, a few years ago. And of course, you can do that. You can win the estate planning game. But all of those books are available, and it's. I just think that having a fundamental understanding of taxation is just so important, given that over half our income ends up in some form of taxation for the average Canadian here. Sorry, go ahead.
What I was going to say, Michael, related to that, not everyone's going to be interested in studying how to minimize tax, but as long as one person in the family cares about that, then you can learn from that person. But it really benefits to have one person take that initiative.
I'm talking with Tim Cestnick. You can also find him writing in the Globe and Mail, but I'm glad you're listening to him here on this show. I'm going to take a break, but I'm going to come back. I'll tell you, I'm going to ask him about investors. Plus, I'm going to ask him about that sale of the primary residence and some details around that. We've been chatting a bit with Ozzie Jurek about that, and I want to get Tim's take on it. So all of that coming your way. We're going to try and save you more money off your tax. Make sure you've taken all the legal deductions you can right here across the Money Talks Network. You're listening to Money Talks. My name is Mike Campbell. I'm really pleased to have Tim Cestnick on with me. This is a tax expert extraordinaire. You can find him in the Globe and Mail. And by the way, I would really recommend any of his tax books, because getting this understanding is really key. Hey, Tim, just before the break, we touched on tax credits that I could transfer to another family member. And I just want to make sure I got that list out. We talked about medical. We talked about charitable. What other things can I sort of move to the higher paying family member?
Yeah, there are a couple of other ones. For example, the pension credit. So if you're receiving a pension from an employer, in fact, you can do even more than just transfer. You can transfer pension income from one spouse to the other. If we're talking about employer or employment pension, not CPP. And so you might as well report some pension income on your return, some on your spouse's. You can both claim the pension credit that way, and that'll save you tax. You can also transfer tuition and education and textbooks tax credits to your spouse. You can transfer the age amount. So if you're over 65 and you don't need the tax credit to reduce your taxes to zero, you can give it to your spouse. And there's also a disability tax credit, which is also transferable in the same kind of way. So and the last thing, one more thing you can transfer, by the way, is dividend income. If you're receiving dividend income on Canadian securities, so Canadian stocks, you can choose to transfer all of your Canadian dividend income to your spouse, not less than all of it, but all of it. And that makes good sense. And you can do that if it increases your spouse's spousal credit, and that can also save tax.
I just want to get one more on the student. Like if a student doesn't have that kind of obviously most students are in low income brackets here. What can a student do? Can they transfer, like you get that tuition credit and stuff?
Yeah, so a student can either hold on to that credit for a future year and claim it in a future year. That's one thing they could do. I find that most students do not end up doing that, though, because you can also transfer to a parent or a grandparent or spouse Up to $5,000 anyway of your tuition credits can be transferred over. And usually we do that because you get the tax relief right away as opposed to saving it for some future year. And by the way, this is the last year for the education and the textbooks tax credits. They're disappearing. The tuition credit will stay around after 2016, but the other two will be gone after this year.
Okay, and now let's go to investors just for a second here and talk about the kinds of things that investors should be aware of.
Right. So first thing to keep in mind, you may be able to claim a deduction for some interest costs. So take a look at your brokerage statements, and if you have any interest expense or costs on there, either because you had a margin account, don't forget to look at those statements and claim that interest as a deduction. People often forget to do that. I think also when it comes to investors, you may be entitled if you lent money to your brother or a friend or somebody for business purposes, and you're not likely to get that money back. And that's happened to too many of us, I think. But If that happens, you may be able to claim tax relief for that, and we call that an allowable business investment loss. And it's kind of like a capital loss, except it's better in the sense that you can offset half of that loss against any kind of income, not just against capital gains. So that's something else to keep in mind. And similar to that, if you are an owner in a small business and your business has grown in value over the course of the last few years, you might be entitled to the capital gains exemption, lifetime capital gains exemption, which will shelter the first $815,000 last year in capital gains. And there are steps you can take today to use up that exemption now.
Hey, by the way, if you used up the $500,000 capital gains exemption before it became more, like you say, 800, do you get that extra 300? Do you know what I mean?
Yeah, you do, and that's a good point, Michael, because a lot of people claimed the exemption in the past, and they think, well, I'm done with my exemption now. I can't claim anymore. But actually, the dollar amount of the exemption keeps going up every year. And in fact, it's already at $1 million for fishing and farming property, so it won't be much longer before we find small business exemptions at that level too. So you may be able to claim an additional exemption that you still have available.
Okay. And let me move to our, one other thing I want to quickly say. Let's say I've got, you mentioned Canadian dividends that I can share, but let's talk about U.S. dividends or U.S. Property, et cetera. How do I determine what exchange rate when I bring it back, or what's the best way of doing that?
Yeah, that's a good question. So CRA expects you to report your worldwide income on your tax return, so even if it's in a different currency. And so most commonly we find people with a lot of U.S. dollar income. You can convert your gains or your profits or your income that may be in U.S. dollars into Canadian, and you can choose the exchange rate you want to use. You can actually use the average for the year, which is what the CRA normally sees people doing, or you can actually choose the exchange rate on the date of the actual transaction or when you receive the income. And what you want to do is do the math both ways and figure out which is best for you, which results in the lower amount of income being reported on your tax return.
Okay, now I'm going to switch gears now because it's sort of a related thing in this way. We've been talking a little bit about that change last year that if I sold my personal or my primary personal residence, I still had to report it. Can you give us a little bit more on that?
Yeah, it used to be that when you sold your home, if you sold your principal residence, most people know that when you sell it, it's generally tax-free. And so if you sell it and it is tax-free, then we've never had to report anything on our tax returns related to that sale. That's all changed now. So starting with 2016, if you happen to sell your residence, your principal residence, you now have to report that on Schedule 3 of your tax return. And the reason the government is doing that is because they want to track this more closely because what they're finding is that there are some people who should not be claiming the principal residence exemption who are claiming it anyway. Some of these people are foreigners and aren't even filing Canadian tax returns. So they're going to catch people this way now. The other kind of individual this is going to affect, though, Michael, are people who buy properties, fix them up, and then flip them. So a lot of people who do this will live in it for a month or two, or maybe not live in it at all, and they'll call it their principal residence when they sell it, and it'll be tax-free. But they've never had to report it on their tax returns because, again, they claimed it as a residence. Well, now you've got to report your principal residence sales. So the government, if you own a property for a very short period of time, a year or two, that will raise a red flag on your tax return now. So what may happen is the government may come back and say, okay, should that really be taxed as a capital gain, or should it be taxed as regular business income? Because it's more like business inventory, buying these homes and flipping them. So that's just something to be aware of if you're into that kind of investment.
We have about a minute left here. What about people who've been claiming a home office space, like 8% of their house was a home office? Is that changing, or are they just going to, is that going to be subject to capital gains and that portion of your primary residence?
No. The good news is that if you use your home, either rent part of it out or to use part of it for a business, that's not going to affect your principal residence exemption, as long as the office in your home or the rental part of your home is what they say is ancillary to the use of the property as a residence. So, in other words, the property is still mainly used as a residence, just part of it is used for home or for business. Then you're okay. Once you get over about half of the home, 50% used for business or for rental, that's when you get into a situation where you may jeopardize part of your principal residence exemption.
Well, Tim, look, there's so much here, and that's why we love to get a chance to visit with you throughout the year, but I really appreciate it this time of year, especially when you've been busy and you make time for us. Thanks so much.
No problem. Anytime, Michael.